Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Wednesday afternoon, actually Wednesday evening, January 28th, 2015, and the title of today's audio blog is FOMC Lunacy Opens the Gates of Financial Hell. Well, there are times when even I am speechless, but briefly, and this is one of them. Not that central bank lies, idiocy, and destruction aren't commonplace, both historically and particularly today. Just look at the lunacy of Abenomics, the PBOC-sanctioned Chinese shadow banking industry, the Swiss National Bank's suicidal euro peg, the ECB's insane open-ended QE, and the Danish central bank's aggressive negative interest rate policy for but a few dozens of modern examples. However, as issue of the world's currency, the impact of Federal Reserve decisions are magnified hundreds of times, as in essence the policies of just three small-minded individuals, Alan Greenspan, Ben Bernanke, and Janet Yellen, have caused more global poverty, wealth inequality, social unrest, and geopolitical tension than all others combined. Not that they did it alone, as again, I can't emphasize enough that it's a misnomer to say the U.S. abandoned the gold standard alone. Back in 1971, America's Bretton Woods partners, i.e. the world's most powerful nations, could have fought back against America's willful breach of contract. But instead, they simply let us do it, realizing that they too could benefit from the license to borrow the gold standard afforded them, at least for a few years. To hell with the world's children, grandchildren, and great-grandchildren. As I've noted countless times, fiat currency by definition is a Ponzi scheme that must grow exponentially to survive, and in the process maintain the confidence of its exponentially growing participants. Mathematically, it is impossible for a Ponzi scheme to survive perpetually, as once the diminishing returns of such growth become apparent, prompting parabolic expansion, in this case of debt, it inevitably implodes, either via a specific trigger event or its own unwieldy weight. Such has been the fate of the previous 599 fiat currencies attempted throughout history, with the only proven way to survive to be conquered by another nation before your own fiat Ponzi scheme implodes on its own. Well, how much more obvious could it be that said diminishing returns were reached years ago, not just in the States but worldwide? Essentially, the marginal return on money printing peaked at the turn of the century's tech wreck and turned negative following the 2008 financial crisis. Today, money printing has become so detrimental that each dollar, euro, yen, and yuan printed has a potential of setting off the big one. And with central banks actively engaged in the final currency war, see last night's Singapore dollar devaluation, the countdown to implosion is clearly down to the single digits. In just the past 2 weeks alone, we have seen the Swiss National Bank and ECB wreak havoc on the world, and most damnably, their own constituents. And this following the Bank of Japan's maniacal expansion of Abenomics barely 2 months prior, and the under-the-radar explosion of Chinese money printing in last year's third quarter. Let alone the expanding race to debase of any central bank that can, whilst those that can't, like those of Brazil and Russia, forced to exponentially raise rates to avoid instantaneous vaporization of their currencies. In other words, central bank economic and social destruction is going parabolic, making it more and more likely that the aforementioned big one occurs this year, and possibly early this year. Before I discuss the utter lunacy today's FOMC statement demonstrated, in my view permanently destroying the last remaining shred of hope of central bank competency, let's just view what the markets looked like before this afternoon's fateful announcement at 2 p.m. Eastern Standard Time. First, recall yesterday when my audio blog was titled Catastrophic Pre-FOMC Drift Failure Portends Yellen Reversal Tomorrow. As for the first time in memory, the Fed's efforts, in concert with those of the PPT, Exchange Stabilization Fund, and Gold Cartel, to, quote, prime the markets for their lies, decidedly failed. To wit, yesterday's 290-point Dow plunge, replete with copper closing at a 6-year low, oil losing its morning goose gains for the third straight day, and interest rate fading into the close. Not to mention gold simultaneously surging, not only dramatically violating cartel rule number 1, i.e., thou shalt not allow PMs to surge whilst the Dow plunges, but forcing the cartel to yet again defend its current line in the sand at the key round number of $1,300 per ounce. In other words, the Fed's ability to maintain its lie about considering future rate hikes was stretched to the limit, if not permanently destroyed. Overnight, the news didn't help Whirlybird Janet either, but then again, whenever does it? To wit, the Singapore dollar devaluation, which in my view is a dramatically damning statement of just how rapidly the final currency war is escalating, but it barely registered on my personal financial Richter scale. No, what did register loudly was the all-out crash of the Baltic Dry Index, ominously to exactly 666, representing not only its lowest ever January reading, but barely above the all-time lows achieved amidst the heart of the 2008 crisis. Then there's this little thing called Greece, which 18 months ago I deemed most likely to catalyze the big one, which just 3 days after its election canceled all its Troika austerity programs, in essence, telling the world it plans to default, perhaps on the entirety of its 325 billion euros of debt, which, when combined with the debt of Greece's banking and corporate sectors, is probably well above 400 billion euros, nearly two-thirds of which is owed to Eurozone creditors. Consequently, the Greek stock market plunged 9% today, putting its post-election losses at 15% and 85% since peaking in mid-2007. Similarly, the Greek bond market collapsed, with its credit default swaps discounting a 70% probability of default. And remember, when I yesterday spoke of the catastrophic collapse of what I once deemed the world's most important stock, i.e. the National Bank of Greece. As it turns out, yesterday's 12% decline was just child's play, as officially today was the worst day ever for Greek bank stocks. To wit, NBG plunged an incredible 22% today, and at a measly $1.03 per share is down, I kid you not, 99.9% from its 2000 high, en route to imminent bankruptcy. Yes, we are talking about hundreds of billions of euros to be written off, and yet not a peep is spoken of the derivatives nightmare that will result. It's as if 2008, 2010, and 2012 never happened, like they were a figment of our imagination. Perhaps the market believes limitless ECB QE will be used to bail everyone out, but frankly, if you believe that, I have a bridge to sell you in Brooklyn. God himself couldn't bail out the pig's debt and derivatives daisy chain that's coming, which when people realize just how far-reaching it is, will be terrified in a manner that will make 2008 itself seems like child's play. And one more notable news item before I get to America's markets was this morning's announcement that Canada's 2014 job create statistics were a sham, just as America's new home sales were proven to be this fall. And oh yeah, America's own NFP employment data several years back, care of the infamous benchmark revisions. Not to mention those of ADP, which 2 years back were also dramatically downwardly revised. Back to the matter at hand, which is what I have long discussed, and not just of American data cookers like the BA and BLS, which is that all economic data are lies, as exemplified by whistleblower admissions that the pre-2012 election NFP data was fabricated, or at best completely meaningless guesses. Regarding the latter, recall back in July when Canada's version of the BLS reported that essentially zero jobs were created, compared to a consensus estimate of roughly 20,000. Well, the Canadian political and financial establishment was none too pleased, and thus, voila, the zero figure was promptly revised to nearly 42,000. And if that credibility hit wasn't catastrophic enough, it was reported this morning that the cumulative 186,000 jobs reported to have been created in Canada in 2014 were actually just 121,000, or 35% lower. And speaking of destroyed credibility, how about that one of the world's newest Wall Street scams, Alibaba? Still valued at an incredible $244 billion for operating one of the world's most commoditized businesses, the Chinese government is actively investigating it for a variety of fraudulent business practices, which, by the way, I have little doubt are true. Fortunately for the powers that be, Apple posted blockbuster earnings last night, which, while having no material impact on global economic activity, allowed the PPT to start the day with a giant NASDAQ futures headwind. In fact, the NASDAQ futures were up something like 70 points early this morning. After all, Apple is the world's largest company. When I arrived at the gym at 6:30 a.m. Eastern Standard Time, Dow futures were up roughly 40 points, NASDAQ futures the aforementioned 70 points, and despite the collapsing Greek market, In a tribute to just how blindly traders worship QE, European stocks were actually up. Copper was barely above yesterday's 6-year low. Closed, the 10-year Treasury yield was roughly flat at 1.8%, the dollar was essentially flat, and oil was barely above its own multi-year lows, barely clinging to the $45 support level that 2 days ago I said appeared ready to break. In other words, aside from Apple, not a single positive thing had occurred since yesterday's ugly close, except that precious metals' attempted follow-through surge was of course capped via prototypical algorithms at 2:15 a.m. and again at the COMEX Open. The PPT's last-ditch effort to salvage some type of pre-FOMC equity market strength couldn't have been more blatant when equity futures surged following Boeing's dramatic reduction of 2015 earnings guidance. However, by mid-morning, the Dow Jones propaganda average was negative anew. The PPT somehow managed to push stock prices modestly higher thereafter, but oil prices broke below $45 per barrel when the largest crude oil inventory increase, actually the largest crude oil inventory period since at least 1982 was reported. Treasury yields started plunging anew, and by the time the FOMC statement was released at 2 p.m. Eastern Standard Time, the Dow was up just 20 points, oil was at the day's low of $44.70 a barrel, the 10-year yield was at an 18-month low of 1.77%, the 30-year was at 2.38%, i.e. 3 basis points above its all-time low, and of course gold was down $8 an ounce. And oh yeah, market-based inflation expectations fell to their lowest level since the heart of the 2008 financial crisis as a blistering 2-year Treasury auction produced record-high prices. Even Wall Street lackeys like Citigroup were writing of how central bank's power base was waning, and Deutsche Bank espoused their expectation that the first Fed rate hike wouldn't take place till October. October? Wasn't it just 5 weeks ago when Whirlybird Janet said she expected a rate hike following just 2 2014 meetings, i.e. in March? Based on the aforementioned, the FOMC had little, if any, ability to credibly maintain its now 3-year lie about economic recovery, as objectively not only is the U.S. economy crumbling, but the entire world. Which is why I expected at least a modicum of humility in their statement, if you will, a Yellen reversal light, citing plunging oil and commodity prices, currencies, and economic data as reasons to at least be cautious going forward. Again, the Fed only takes action when the PPT loses control of the stock market, which is why neither I nor anyone else expected even a hint of discussion about contemplated easing measures. However, it's one thing to lie about your actions, and another entirely to completely ignore reality, which is exactly what the FOMC did, despite the entire economic world crumbling around them. In other words, the title of yesterday's Audioblog, 3 Historic Central Bank Failures in 1 Week, Do I Hear 4, turned out to be spot on, as not only did the Fed once and for all destroy its own credibility, but as the world's most important financial institution, any remaining credibility the entire central banking community still had. Which, by the way, is a statement I'm not making flippantly, as consequently, I truly believe the financial gates of hell noted in today's title have indeed been opened. And not in the coming months, but now. As noted earlier, the only way to maintain a Fiat Ponzi scheme, aside from exponentially growing money printing, is by maintaining confidence. And following the horrifying, nation-killing actions of the BOJ and PBOC last fall, and the SNB and ECB last week, confidence was already all but dead when the FOMC statement was released. Of course, the only credibility the Fed still has is due to the fact that its sister agency, the PPT, has been able to successfully support the Dow Jones propaganda average, whilst its brother agency, the Gold Cartel, suppresses paper gold and silver prices, and its cousins at the BA and BLS pump out one fraudulent economic report after another. Otherwise, the Greenspan-Bernanke-Yellen Fed has been an abject failure in every aspect, as the real economy is in shambles, with the only growth experience in the past 15 years being in debt, government spending, taxes, corruption, lobbying, entitlements, and financial criminality. Not to mention the blatant lies of previous FOMC statements, such as 6 weeks ago when it deemed the accelerated oil price plunge and, quote, other factors to be transitory. However, today truly took the cake for central bank lunacy, and what scares me most is not so much their cancerous policies or a political structure that appoints a handful of dimwits to manage the fate of our collective net worth, but instead it's the fact that these Washington and Wall Street lackeys have not a clue how much damage they're causing to both millions of Americans and billions of foreigners. To wit, amidst the aforementioned 2008-like deflationary economic and market backdrop, and literally endless amounts of ominous political, economic, and financial developments in the past week, much less the 6 weeks since their last meeting, this is all the 75 or so taxpayer-funded participants could come up with. Okay, now we're in the FOMC boardroom, with roughly a dozen Fed governors and scores of useless lackeys. Unquestionably, Janet Yellen has already been, quote, consulted by everyone from the president to the too-big-to-fail bank CEOs to leaders of other world-destroying central banks. All she cares about is doing whatever it takes to kick the can a few more weeks, and thus, completely irrespective of the aforementioned issues, her team of wordsmiths try to determine what wording will enable the PPT to successfully support the Dow, the cartel to successfully suppress PMs, the Exchange Stabilization Fund to successfully manage currencies, and its own manipulation department to prevent rates from ominously plunging or exploding. Clearly, it was predetermined that any and all bad news would be ignored, and while its aggressive language about potential rate hikes would obviously be avoided, the Fed by no means wanted to sound even slightly more dovish, as doing so would all but prove their failure and circulate the expectation that global QE to infinity had arrived. Clearly, this was the same strategy as they deployed in the December 17th meeting, although at that time they were able to get away with their lies. This time around was another story, as trust me, when I'm surprised by the Fed, something's very, very wrong. Per yesterday's Audioblog, I saw it as nearly impossible not to address reality in some way, shape, or form, and yet that is exactly what they did, well, for the most part, per the below changes in their pathetic statement. To start, they characterized economic activity since the December 17th FOMC meeting as, quote, solid, as opposed to the, quote, moderate description of economic activity prior to the December meeting. And better yet, they probably wrangled for hours until finally deciding to characterize the past month's jobs gains as strong, as opposed to the December statement describing the prior month's gains as solid. No, really, I'm not making this up. This is what the 75-person FOMC meetings are really about. And as for such descriptions, how in God's name could any sentient being claim that economic activity has improved in the past 6 weeks? I mean, during that time, we have experienced the below checklist of political, economic, and financial horrors, any one of which could and should be characterized as troublesome at the least and catastrophic at the worst. 1. Oil plunged from $59 a barrel to $44, yielding massive capex reductions, layoffs, and financial losses. 2. The CRB index plummeted from 242 to 214, in a hair's breadth of the 2008 spike low of 205. The 10-year Treasury yield plunged from 2.3% to 1.72%, and the 30-year yield from 2.8% to an all-time low of 2.29%. The Swiss National Bank depegged the franc from the euro, causing catastrophic financial losses and accelerating the freefall plunge of the world's most widely utilized currency. The ECB initiated an utterly insane open-ended QE program because the European economy has all but died. Greece elected a government that wants to default on hundreds of billions of euros and secede from the European Union. Geopolitical tensions in the Ukraine have gone off the charts, yielding the very real potential for a cataclysmic war. The dollar index surged by a whopping 7%, yielding massive downward earnings revisions across corporate America and massive global inflation. U.S. economic data has precipitously plunged in nearly all categories. The holiday shopping season would end up being an unmitigated disaster, not far gone from that of the 2008 financial crisis environment. And as noted above, the Baltic Dry Index plunged from 850 to 666, or 22%, to its lowest ever January reading, barely above the spike lows of 2008. But other than that, Mrs. Lincoln, how was the play? Next up, they claimed household spending is rising moderately, which, based on the negative retail sales growth just reported for December, during the supposedly strongest spending period of the year, I failed to understand that statement, or better yet, the propaganda inserted therein that recent declines in energy prices have boosted household purchasing power. Yes, unless you are working in the energy industry, or the various industries whose demand plunges are a primary reason why the aforementioned, quote, tax cut occurred. Recall, both gasoline and housing prices plunged in 2008 too. However, it certainly wasn't for a positive reason and decidedly did not increase spending. At least the Fed admitted that deflation has since worsened, in their own words, quote, substantially. However, they tell the biggest whopper of all time when subsequently stating that, quote, longer-term inflation expectations have remained stable. I mean, what part of the 30-year Treasury yield not only falling to an all-time low of 2.29%, but barely being above your short-term inflation target of 2.0% am I missing? While still in the category of bold-faced lies, transparent to even a modestly intelligent 10-year-old, the FOMC claimed that the risks to the outlook for economic activity in the labor market are, quote, nearly balanced. Nearly balanced? What exactly are the mass layoffs from everyone from corporate titans to countless energy firms and spiking weekly jobless claims are nearly balanced with? Or plunging economic data, particularly as relates to new orders, employment, and capital spending? That said, the most pathetic clause of today's FOMC drivel was that, quote, inflation is anticipated to decline further in the near term, but rise gradually toward 2% over the medium term, as the labor market improves further and the transitory effects of lower energy prices and other factors dissipate. Within this clause, the only change from last month's statement is that as opposed to December, when they expected inflation to, quote, rise gradually toward 2%, they now expect inflation to decline further in the, quote, near term, but rise gradually toward 2% in the medium term. This has to be the most brain-dead wordsmithing I've ever heard, and frankly, I'm chuckling to myself thinking of how Peter Schiff will interpret it, in asking how one differentiates the near term from the medium term. Of course, despite the Fed's incessant economic cheerleading and, generally speaking, refusal to acknowledge reality, unless of course the stock market is crashing, the fact that they admitted to the expectation of further near-term deflation is as dovish as it gets. In essence, validating my expectation that at least in some way, shape, or form, the long-awaited Yellen reversal would commence today. Let alone the one additional extremely ominous word they added in the statement's last paragraph. In adding to their usual claptrap about monitoring a variety of factors, they are now monitoring international developments as well. In other words, acknowledging the fear they are now experiencing, which is probably why they made not a peep about the potential for future monetary tightening, other than to say they will continue to be patient. In other words, despite Wall Street's desperation to portray the statement as incrementally hawkish, it not only was decidedly dovish, but in failing to properly address reality by speaking of the potential for additional easing measures, it delivered an even more lethal death blow by destroying any remaining shred of credibility it still had. Immediately following the statement, the various manipulation algos were utilized to influence the dim-witted statement's perception. However, if yesterday's pre-FOMC drift manipulations were an abject failure, today's were an unmitigated disaster. Yes, they managed to cap gold's attempt to surge ahead, but in the end, it was only down $10 an ounce, and silver a measly dime. However, deflation fever was decidedly not avoided elsewhere, starting with the Dow, which following yesterday's 290-point plunge, closed at the day's low, down 190 points. And don't forget, the Nasdaq was up 70 points in the morning and ended down over 40 points. Oil collapsed further, ending at $44.30 per barrel. The CRB index plunged 1.4%, the dollar exploded higher, and most ominously of all, interest rates literally fell to the floor, with the 10-year yield plummeting from 1.78% at the time of the announcement to a new multi-year low of 1.72%, and the 30-year yield slicing through Tuesday's all-time low close of 2.35% like a hot knife through butter, closing at 2.29%. And oh yeah, due to the aforementioned dollar surge, gold was still higher in a variety of global currencies, including the Canadian dollar, Australian dollar, Swiss franc, and euro. Again, what scares me most is that the entire world is starting to realize that, like the ECB, BOJ, SNB, and others, the Fed has absolutely no idea what they're doing. The carnage central banks are causing to hundreds of nations and billions of people is incalculable, and the worst part is it's just starting. This is why gold and silver, despite historic efforts to suppress them, are not only rising in dollars but surging in nearly all currencies. Shortly, the maniacal line in the sand at $1,300 an ounce will fall just as $1,200 did, as will $20 per ounce silver for that matter, en route to record highs in the coming years. Or, if the powers that be completely lose control, as is clearly in the process of happening right now, significantly sooner. To wit, I noted above how the Fed only acts when stocks are falling. And how about that? That's exactly what's occurring as we speak. And if you think the political, economic, and financial horrors that occurred between the December and January FOMC meetings were bad, just wait until the March meeting, at which point the full impact of the catastrophic commodity, currency, and crude plunges will start to be felt. not to mention the Greek saga and who knows how many other black swan events. In my view, today's spineless, negligent FOMC statement completed the process of central bank credibility destruction that started in 2008, not just in the States, but worldwide. I truly believe the sum total of the Fed's world-destroying activities have opened the gates of financial hell, and thus can't comprehend how any financially savvy person could eschew at least a modicum of financial insurance in the form of the only real money the world has ever known. To that end, if you decide to take action by buying or storing precious metals,